Most traders do not lose because their analysis is completely wrong. They lose because they are right, too early. They see a stock approaching support, so they buy before it actually holds. They notice the first green candle, so they enter before a trend is confirmed. They predict a breakout, place their money on the line, and then watch the market move violently in the opposite direction. A few minutes later, their stop loss is hit, and then something painful happens. The market reverses and moves exactly where they originally expected it to go. Their idea was right. Jesse Livermore understood this better than almost anyone. He studied the behavior of markets during periods of fear, greed, uncertainty, accumulation, and speculation. His experience taught him that identifying a possible opportunity was only the beginning. The real money was made by waiting until the market itself confirmed that the opportunity was ready. Not predicting, not hoping, not forcing, waiting. Because the market does not reward the trader who moves first. It rewards the trader who moves at the right moment. Today, you are going to discover why traders enter too early, how premature entries quietly destroy trading accounts, and what must happen before you risk money on your next trade. This lesson could completely change the way you see the market, because your next trade may not require a better indicator. It may simply require more patience. Every premature trade begins with an emotion, the fear of missing out. You see price beginning to move, and immediately your mind creates a story. This could be the breakout. This may be the bottom. If I do not enter now, I will miss the entire move. Your heart rate increases. Your attention narrows. Suddenly, waiting feels dangerous. You stop thinking about risk and start imagining profit. You picture the market exploding upward without you. And because you do not want to feel left behind, you enter before your conditions are complete. At that moment, you are no longer responding to the market. You are responding to your imagination. The market has not confirmed your idea, but emotionally, you have already accepted the future you want. This is one of the most expensive habits in trading. A professional trader does not need to capture the first dollar of a move. A professional wants the safest portion of the move, the part supported by real evidence. Amateurs try to buy the exact bottom and sell the exact top. Because doing so makes them feel intelligent, they let somebody else take the initial risk. They wait for price to reveal its strength. Then, when the evidence becomes clear, they act decisively. You do not have to be first. You have to be right at the moment your capital enters the market. There is a major difference. Imagine that a stock has been falling for several days. The decline looks excessive. Price is approaching an important support level, and an indicator says the market is oversold. An inexperienced trader thinks, it has fallen enough, it must reverse now. So he buys. But fallen enough is an opinion. Oversold is a condition. Neither one proves that buyers have taken control. A market can remain oversold longer than a trader can remain financially and emotionally comfortable. Price can break through support, continue falling, and create another support level much lower. The trader was not necessarily foolish for noticing a potential reversal. The mistake was treating a possibility as if it were a confirmed event. Anticipation says, I believe this will happen. Confirmation says, the market is showing me that it has started to happen. That distinction can protect your account. A potential breakout is not proof that it will hold. A candle moving above resistance for a few seconds does not mean price will close above it. The market constantly produces movements designed to attract impatient traders. Price pushes toward a level. Volume briefly increases. The candles become exciting. Traders rush in. Then the move fails, trapping everyone who acted before confirmation. If you consistently enter on expectation rather than evidence, you become liquidity for more patient participants. Your entry gives somebody else the opportunity to exit. Your stop loss becomes part of the fuel that moves price in the opposite direction. You're standing directly in its path. Jesse Livermore's approach was built around observing price behavior, rather than arguing with it. He understood that the market does not owe a trader an immediate move simply because the analysis appears logical. A stock may look cheap and continue falling. It may look expensive and continue rising. A trend may appear exhausted and still travel much farther than expected. Livermore learned to respect what price was actually doing. He looked for important levels where market behavior could reveal whether demand or supply was becoming dominant. The principle was simple but psychologically difficult. Do not act merely because the market reaches an interesting area. Watch how the market behaves when it gets there. Watch how the market behaves when it gets there. Does price reject the levels strongly? Does it break through and hold? Does momentum expand? Does volume support the movement? Does the market follow through, or immediately retreat? These questions transform trading from prediction into observation. Livermore did not need to know every event that would occur tomorrow. He needed to recognize when the market's present behavior supported a calculated decision. That is what many traders miss. They spend hours trying to predict the future while ignoring the evidence unfolding directly. It damages the entire decision-making process. First, it forces you to use a wider stop-loss. Because your entry has no clear confirmation point, you often do not know exactly where the trade becomes invalid. You tell yourself, I will give it a little more room. Then, a little more, and a little more. A trade that should have risked 1% suddenly threatens 3 or 4% of your account. Second, early entries trap you inside uncertainty. Once your money is involved, you can no longer observe the market objectively. Every candle becomes personal. A small drop feels threatening. A temporary rise feels like validation. Your mind begins searching for information. Your mind begins searching for information. Your mind begins searching for information that supports the position you already hold. You stop reading the market. You start defending your trade. Third, premature entries exhaust your emotional capital. You may enter, get stopped out, enter again, and get stopped out a second time before the real move finally begins. By the time valid confirmation appears, you are frustrated, afraid, or unwilling to take another trade. You miss the opportunity, not because you failed to see it, but because impatience consumed your confidence before the opportunity was ready. Finally, entering too early creates destructive habits. Each time you act without confirmation, you train your mind to prioritize excitement over discipline. Eventually, trading begins to feel like gambling. You click because you are bored. You enter because price is moving. You risk money because waiting feels uncomfortable. This is how a serious trading plan slowly disappears. Not through one dramatic decision, but through hundreds of small, impatient ones. Before entering your next trade, look for 3 essential conditions. Condition 1. Location. A good trade begins at a meaningful location. Price should be interacting with an area that matters, such as established support, resistance, a previous high or low. A consolidation does not tell you which direction it will leave. The level gives you a place to pay attention. It does not give you permission to trade. Many traders lose because they confuse an area of interest with a complete setup. Price touches support, and they immediately buy. Price reaches resistance, and they immediately sell. But levels are not concrete walls. They are areas where buyers and sellers negotiate. Sometimes a level holds. Sometimes it breaks. Your job is not to assume the result. Your job is to observe the battle. Condition 2. Confirmation. Once price reaches your location, demand evidence. Confirmation may take different forms depending on your strategy. It could be a strong rejection candle, a lower high developing after an advance, an expansion in volume, a clear change in market structure. The exact trigger matters less than consistency. You must define confirmation before the trade, not invent it while emotionally involved. If your plan says you need a candle to close above resistance, then a wick above resistance is not enough. If your plan requires a successful retest, the first breakout candle is not your entry. If your strategy needs increasing volume, a weak move on declining participation should not persuade you. The purpose of confirmation is not to eliminate all risk. That is impossible. Its purpose is to improve the quality of uncertainty. You are still dealing with probabilities, but now the market has provided evidence supporting your decision. Condition 3. Follow-through. This is the condition many traders ignore. A market can briefly confirm a move and then fail. That is why follow-through matters. After the signal appears, does price continue behaving as it should? Do buyers protect the breakout? Do sellers remain trapped below resistance? Does momentum persist? Or does price immediately return to its previous range? Strong trades often display urgency. Not location tells you where to watch. Confirmation tells you when the opportunity may be ready. Follow-through tells you whether the market is accepting the new direction. Together, these 3 conditions create a much stronger foundation than emotion and prediction. Breakouts create some of the most powerful opportunities in trading. They also create some of the most painful traps. Price approaches resistance. The market becomes active. A candle pushes above the level. Traders see the movement and rush to buy. They bought the appearance of a breakout. There is a difference. A level being crossed intraday is not the same as a market accepting price beyond that level. This is why waiting for a close can be powerful. The close shows where price was able to remain after the battle between buyers and sellers. For additional confirmation, some traders wait for a retest. Price breaks resistance, moves higher, then returns to the old level. If previous resistance now acts as support, the market may be revealing genuine strength. You will not capture the very bottom of the move. The professional asks, how much evidence do I need before the risk becomes acceptable? One question is driven by greed. The other is driven by survival. Reversals are even more dangerous. A falling market can look attractive long before it becomes safe. After a large decline, every small green candle appears to be the beginning of a recovery. Traders tell themselves the asset is cheap, but cheap can become cheaper. A downtrend does not end because price has fallen a certain percentage. It ends when market behavior changes. Before attempting a long position in a falling market, look for signs that selling pressure is actually weakening. Has price stopped making lower lows? Has it established a higher low? Has an important resistance level been reclaimed? Are buyers showing sustained strength? Is the market building a base, or are you reacting to one emotional candle? Trying to catch the exact bottom is attractive, because the potential reward looks enormous. But the bottom is only obvious after it has formed. Before that, you are standing beneath a falling object and hoping gravity has finished. Allow the market to prove that it can support itself. Let structure change. Let buyers demonstrate commitment. You may enter later. Losing money repeatedly while trying to predict the bottom is failure. Many traders believe waiting means doing nothing. That is incorrect. Professional patience is active. While waiting, you are studying price. You are identifying levels. You are calculating risk. You are preparing different scenarios. You are deciding what must happen before you enter, and what would completely invalidate the setup. You are preparing to act without hesitation when your conditions are met. This is not laziness. It is controlled readiness. His decision has been rehearsed. When the correct moment arrives, action is immediate. Trading requires the same mental discipline. Wait without becoming distracted. Observe without becoming emotionally attached. Prepare without predicting. Then act when your plan and the market finally agree. The best traders are not permanently active. They are permanently attentive. There may be no valid trade for hours. Sometimes, there may be no valid trade for days. That does not mean you are failing. Protecting your capital while conditions are poor is a successful trading decision. Cash is not an embarrassment, not why the market could move. Why must the entry happen at this specific moment? What changed? What evidence appeared? If your answer is simply, I am afraid of missing the move, do not enter. Fear is not confirmation. Question 2. Has my trigger fully completed? If your strategy requires a candle close, wait for the close. If it requires a retest, wait for the retest. If it requires a structure break, allow the structure to break clearly. Do not weaken your rules because the current candle looks exciting. A proper stop loss is not placed where the loss feels comfortable. It is placed where the original trade idea is no longer valid. If you cannot identify that point, your setup may not be clear enough. Question 4. Is the potential reward worth the risk? Even a strong setup can be a poor trade if the entry is too late or the stop is too wide. Calculate the risk. Identify the realistic target. Do not rely on fantasy. If you must risk $3 to potentially make one, patience is probably the better position. Would you risk the same amount if your only goal were disciplined execution? A good trade does not need applause. It only needs a valid setup. If you cannot answer all 5 questions clearly, the market has not given you enough reason to risk your money. Patience does not appear automatically. It must be trained. Start by creating a written entry checklist. Keep it short enough to use but strict enough to protect you. Your checklist might include, is price at a meaningful level? Has my exact confirmation appeared? Has the signal candle closed? Is volume supporting the move? Is the risk to reward acceptable? Where is my invalidation point? How much of my account am I risking? If one critical condition is missing, there is no trade. Next, Capture screenshots of every entry. Record the chart when you enter, and again when you exit. Then review the trades at the end of the week. Do not only examine profit and loss. Ask whether the entry respected your process. A profitable trade taken without confirmation is still a dangerous trade. It rewards behavior that may later create a much larger loss. A losing trade taken with perfect discipline may still be a good trade. No setup wins every time. Your job is not to eliminate losses. Your job is to ensure that every loss came from a calculated decision, rather than an emotional reaction. You should also track how often you enter before confirmation. Every time you break the rule, record it honestly. After 20 or 30 trades, calculate the cost. You may discover that one habit is responsible for a large percentage of your losses. Once the damage becomes visible, discipline becomes easier. Finally, practice watching valid opportunities move without you. This sounds strange, but it is powerful. If a market moves before your confirmation appears, let it go. Do not chase. Remind yourself, that move did not belong to my strategy. There will always be another market, another setup, another day. Some traders wait correctly, receive full confirmation, and then become afraid to enter. They analyze one more indicator. They search for one more opinion. They wait for absolute certainty. By the time they act, the opportunity is gone. The purpose of waiting is not to avoid every trade. It is to prepare for decisive action. Before the market opens, define your conditions. If this happens, I enter. If this does not happen, I remain out. If this level breaks, my idea is invalid. If the trade reaches this point, I manage it according to my plan. Make the decisions while calm. Then, when the setup appears, execute. This is the balance every trader must develop. Patience before the signal. Decisiveness after the signal. If you act too early, you gamble. If you act too late, you chase. But when preparation, confirmation, and execution meet at the same moment, you trade with purpose. The market will test your patience before it rewards your discipline. It will move close to your level, and then pull away. It will create candles that look convincing but fail before closing. It will make you feel that everyone else is making money. It will whisper that this opportunity is different, that you must act now, that waiting will cost you everything. You are paid for the quality of the decisions you make. Your goal is not to participate in every movement. Your goal is to protect your capital until the odds justify the risk. Jesse Livermore's experience offers a lesson that remains relevant across generations of traders. Market direction matters, but timing determines whether your idea survives long enough to become profitable. So before your next trade, slow down. Let the candle close. Let the level prove itself. Let the market reveal its intention. You may enter a little later. You may miss a small part of the move. Sometimes, you may miss the entire trade. But what you save through discipline can be far greater than what you lose through waiting, because opportunities are endless. Your capital is not. Stop entering too early. Stop treating movement as confirmation. Stop risking money simply because your imagination has already reached the target. Wait for the evidence. Trust your process. And when the market finally gives you the signal you planned for, act without fear. Not because you know what the market must do next, but because you know exactly what you will do, whatever happens. That is the difference between prediction and preparation, between impulse and discipline, between a trader who constantly reacts, and a trader who survives long enough to become consistently profitable. The market will always create another opportunity. Make sure you are still prepared, and it's still funded. If this lesson changed the way you think about entries, subscribe, and continue building the discipline most traders never develop. And before you place your next trade, remember one question. Has the market truly confirmed my idea, or am I simply afraid of being left behind? Wait for the right moment. Protect your capital, and let the market come to you. This video is for educational purposes only, and does not constitute financial advice.